On this Thursday morning, welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Brian Sozzi this morning. Let's get to the three things that you need to know today.
All right, first up, the day after Christmas is for markets analysis. Stock futures are falling, giving back some of those gains we saw earlier this week. Treasury yields ticking higher, the 10-year above 4.6%. The major averages posting 2 days of gains before the Christmas holiday. Investors are now watching to see if the markets can pull off a Santa Claus rally in these last few trading days of the year and the first couple in January. No doubt it has been a tough month for stocks. The Dow off more than 3%, in part caused by a more hawkish Federal Reserve.
And initial jobless claims for the week ended December 21st, clocking in at 219,000. That is versus the 223,000 that was expected, just slightly lower than the week prior as well. Now, the continuing claims, the number of people receiving unemployment benefits hit its highest level in 3 years. Overall, the labor market still strong, something that the Fed has upheld as a reason to comfortably slow the pace of rate cuts in 2025. But Wall Street is looking for any signs of significant cooling.
Wall Street loves its cuts, and tracking Bitcoin prices as they are lower this morning. The cryptocurrency has not traded above $100,000 in a week. Oh my God! This recent weakness comes in the wake of a massive Trump election rally. Bitcoin surged more than 50% following the election until its recent peak over $108,000.
Let's do a quick check of the markets right now. Stock futures, they are lower as we're just outside of, well, we're about 30 minutes until the start of trade here on the day. And you're taking a look at the Dow futures down fractionally by about 0.4%. S&P 500 down about the same there, 0.3%, and about the same on a percentage basis for the Nasdaq futures. We're also keeping close tabs on treasuries this morning. They are higher. Wall Street looks at some fresh jobs data in the form of initial jobless claims coming in lower than expected for the week ended December 21st. 219,000 versus the 223,000 that were estimated coming into it. We did see continuing claims tick up as well here. And of course, as we're tracking all of this, the larger inclination for traders is to think about what this ultimately means for what the Fed has continued to discuss with their dual mandate and the labor market and the strength of the labor market that they're continuing to discuss going into, of course, the new slate and of a calendar year in 2025 when their next set of meetings will begin.
Look, Brad, I'm not going to sit here and make a big deal about jobless claims coming in 219,000. This will just be one small component of what the Federal Reserve is watching here as it pertains to what they may do on interest rates. I think back to what Mary Daly told us, Brad. You know, I think she'll be looking at several factors in the economy, labor market, of course, the PCE in coming months to see what they do on those rates.
Absolutely.
All right, stock futures are in the red after gaining in day one of the Santa Claus rally period on Tuesday. So will Santa end up riding his sleigh into the new year? I like that one. Joining us now is Michelle Snyder, Chief Market Strategist at MarketGauge.com. Michelle, good to see you. We got some notes from you saying this is you're focusing on the year of the snake and what that might mean or may not mean for stocks. Break this down for us.
Well, first of all, good morning. Well, it's interesting because I have been following Chinese astrology at the start of every year for a long, long time. And some people might think that that's kind of silly, but there is a great quote by J.B. Morgan that says, millionaires do not follow astrology, billionaires do. And I think it's because there's a layer out there that we have to be aware of. And I always like to say with 1.7 billion people who follow this in the Asian world, it means something. So the snake actually coming out of dragon could mean more peace, more harmony, prosperity, but it also could mean some volatility. And that's basically what we're keeping our eyes on, with certain signals much more concrete than just following the astrological sign.
What do the spirits of the snake tell us about how people might be investing?
Well, I think basically what it's very, very prosperous potentially for the Asian markets, which makes a lot of sense because they were so beat up over the last year, excuse me, in comparison to what the U.S. market has done. So I think we have to keep our eyes there. I think it also means that if you want to use the metaphor, a snake can coil and hiss and spit, but it can also travel very peacefully. So that's why I think you have to be prepared, particularly with the Fed, how it's set up for next year, a new administration coming in, for some downturns in the market and maybe a rough start. to the year, and then possibly by spring, we start to see things level out. It's also very much in line, by the way, with 1965, which was the last time we had this yin wood snake. And that was a year that started out somewhat tumultuously, but ended well with about 3-4% gains. Case-Shiller's kind of there too. So that's kind of what we're looking for as well.
Yeah. Absolutely. Look, most of my dreams or nightmares that have snakes in them are not anything about peaceful travel at all. So I hope that there is some peaceful travel in there aside from the hissing and spitting. You know, as we think about what you mentioned in the new administration coming in, it seems like there has been some hissing, at least pre the inauguration day, and now there's going to be a lot of focus on a few themes, and two of them that jump out to me that I know you're laser focused on as well. One of them you mentioned in deregulation, and the sectors that might be early beneficiaries of that. Financials has really caught a lot of attention there. What's your kind of analysis?
Well, yeah, in terms of deregulation, of course, it's always going to be when and to what degree, and then what, of course, is the aftermath of that. So deregulation sounds great, right? Less government control. But it also means that there has to be some level of oversight. So we know that that can create some issues if the oversight is not necessarily thought out well. So we're looking at that as maybe, at least initially, what people think is, yay, great. But we'll see how much can actually take place as we get into the administration. I think you can look at that in every aspect of what Trump has promised. To what degree, by when, how much friction will they get in return of that? And then, of course, the uncertainty of all of that, what that does to the market.
Michelle, you actually inspired me to check my horoscope in real time. It says I will have a great day and I will talk about stocks from morning to night. So typical day for me. Let's go into some of your picks to that end. I want to lock in on Salesforce, because I just had a chat with Salesforce CEO Mark Benioff, and he was telling me that next year is going to be the year of agents, charging $2 per conversation on millions of agents. I think they're going to rack up some big bucks. Is that your play here?
Well, I love that stock. I've liked it pretty much. Really, it came into my head when I saw the Olympics, because they were one of the big sponsors in July of the Olympics. And then I was watching football yesterday, like everybody else probably. And CRM was Salesforce was a huge part of the sponsor on the Netflix.
Yeah, I saw what was Matthew McConaughey got rained on, right?
Yes, exactly. Yeah. That was a great commercial.
Great commercial.
So, I mean, forget about that. But that obviously what they're showing is they're in the marketplace and they're talking about AI, which, of course, is the great buzzwords of 2023, 2024. And I'm imagining 2025. And so they're really focusing now on increasing AI in terms of how they deliver to customers, marketing, sales. And that means to me that right now, if you look at the chart of that stock, which is pretty hot at around 360, I see no reason why it can't go to 500. Obviously, if the market behaves.
I was surprised to see Rivian on your list, Michelle. And I mention this because, of course, Tesla's really hot. You have basically Elon Musk, second commander-in-chief, however you want to call him. Isn't Elon's connection to this administration bad news for Rivian? And also in the context, Rivian is not making any money, and it's unclear when they will turn profitable.
Yes to both. But however, Rivian does have access to the Tesla charging stations. So it's not necessarily totally in opposition of one another. What I like about Rivian is a couple of things. They had some really good deals this year. The deal with Volkswagen, they got some money to continue to build the plant. They're working on a lower price model. Car and Driver gave them unbelievable reviews. In terms of customer satisfaction, I've read nothing but great comments by people who own Rivians. But the thing is, it's made in America, and that's the thing that really attracts me. In terms of Tesla, cannot be the total monopoly, although it looks that way right now. I think Rivian can benefit. And in terms of turning a profit, well, there were certainly arguments that Tesla didn't turn a profit for years and years while that stock did very well. So a lot of it is going to be the perception, and if EVs aren't quite as challenged as what the administration originally came out with because of Musk.
Michelle, just lastly, while we have you have a couple Bitcoin adjacent names that are on your list too, and it caught my attention, especially with regard to Ripple and then also blockchain here. As you're taking a look across the risk appetite that certainly is perhaps best gauged by how many people and what the flows are into Bitcoin, how are you assessing some of the other tertiary plays within the sector?
Well, right, I think that Bitcoin can continue to be somewhat volatile. This 89 to 95 level is kind of really key here. And if that breaks, I think we could see maybe more serious selling. But in terms of XRP, it's an interesting thing because, first of all, it's a cross-border transactional type of situation that is used globally. And of course, here we wound up with the SEC lawsuit with Gary Gensler leaving. It got an initial burst. And even though we haven't started, obviously, with the new administration, I actually think even though the lawsuit's still there, that could be lifted and that could be very good. It's a very efficient system. In terms of blockchain, digital ledger, that's been a lot less volatile. And I think blockchain technology, regardless of what happens with the individual coins, is here to stay, will evolve. And I like that stock where it's been holding over $45, let's say, if we want to be generous with support. So I see upside potential there as well.
Michelle, thanks so much for taking the time here with us today. Great to see you.
Great to see you too. Thank you.
Time now for our chart of the day. We're looking at the weighting of the top 10 holdings in the S&P 500. I'll kick it on over to Sazi across the studio here.
Hey, thanks so much, Brad. Yeah, quick burst of analysis here, technical analysis. Really interesting chart here, looking at the weighting or the top 10 holdings inside of the S&P 500. As you can see high here, it's never been higher, almost 38%. Those top 10 holdings really dominating or continuing to dominate the S&P 500. Why this stood out to me? One, because it is at an all-time high, but it is also higher than when people owned a lot of those tech stocks in 1999 during that internet.com boom. Of course, within these holdings, you have companies like Nvidia and Apple. And a big play here, of course, Brad, is everybody betting on the great AI infrastructure build out, not just continuing next year, but accelerating in 2025, accelerating even more in 2026. And that's why you see a lot of investors really bulled up Nvidia, Apple, and you name it.
Absolutely. Let's also take a look at Tesla shares here this morning. We are tracking that name on pace to end the year with a 2% decline until the election of Donald Trump here. Now, since November, Tesla shares have added $570 billion in market cap. Now it's on pace to outperform the S&P 500. There you're taking a look at shares of TSLA. They are up year to date, 86% here. And of course, a few themes that have really been called out with regard to Tesla and of course, its figurehead and poster child in Elon Musk, founder and, of course, CEO, who continues to have very close relationships with someone he campaigned with and now is the president-elect and President-elect Trump. And it'll be interesting to watch specifically how he has the ear of President Trump. I mean,
he's got both ears.
People are upsetting Trump.
He's got his whole body.
By calling Elon President Musk at this point.
Yeah.
It seems like that's getting under some people's skin.
Yeah, but I think Michelle made a very important point, Brad. Michelle Schneider, who we just had on Rivian. She made a point that Tesla, despite Elon's involvement in government and the Trump administration, is not going to have a monopoly on EVs. Very important there. So you're seeing, of course, Tesla shares up significantly after the election. In part, I think, because investors think they do have a monopoly, but there's a lot of other companies out there. Rivian makes a good vehicle. General Motors, our Comeback of the Year award winner. Of course, Mary Barra leading the charge there. No pun intended on EVs. A lot of good models coming from them next year, including, I think, the Silverado EV. So by and large, I mean, I get it why Tesla's up this much, but you have to wonder how much more room upside is there into the stock. A key to unlocking further gains, Brad, I would argue, they have to start delivering some of these cyber cabs in the middle of next year. If they miss that delivery mark, you can see some profit taking here.
Yeah, no, absolutely. And the bigger thing for GM and our comeback story of the year, as we were mentioning too here, is really what takes place as they are exiting or at least trying to figure out what to do with that robo-taxi business. They're going to be exiting that here. Of course, that has been one of the larger spends that this company has continued to put forward, especially with autonomous vehicles in mind, which is also top of mind for Tesla and their cyber cap as well.
And then top of mind too, last I'll add, is the impact of tariffs. And if you go onto Yahoo Finance this morning, you'll see a clip from my opening bid podcast talking to a really Hall of Fame auto analyst, John Murphy, and he's discussing why tariffs are a big problem for the entire auto industry. It's not just that a GM may have to pay more for steel, Brad. It's the components. Mm-hmm. It could be an electric wire that goes in the car. Everything, the cost of making a car, whether it's Tesla, Rivian, Ford, General Motors, Toyota, whatever it is, could rise pretty significantly if these tariffs go through. Might hit margins, might hit free cash flow, and then all these stocks get hit.
Absolutely. Well, we're going to continue to track that. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. We've got much more on the other side of this short break. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers, and you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, there's supposed to not be any fighting on Christmas Day, but entertainment giants Netflix and Disney, they were going blow for blow to prop up viewership. Netflix featured 2 NFL games, plus a Cowboy Carter halftime show, which is being heralded as the Beyonce Bowl. Disney, meanwhile, broadcasted a slate of NBA games, a tradition dating back to 1947 for the league here, but it is really the NFL and this new partnership with Netflix, which is more of their foray into sports and And of course, you got a huge halftime show in Beyonce stepping on stage, all of the different kind of Beyonce trades that you can annex to this one, whether it be Levi's, whether it be Netflix, whether it be Spotify. There's a few different ways to really take a look at what took place yesterday and say, all right, here's how investors might be pricing in what is to come on January 14th as well.
Just seeing Beyonce come out there on the horse, I mean, that made this whole event for me. I get the Chiefs won. It was fun to watch that, and that's cool. But this was really, I think, Brad, these games were the first time I got a sense that Netflix is getting this live sports thing under control. Like what they had been doing, notably with the Tyson Paul fight, it didn't feel right. It felt like they were missing something. It felt like things were thrown together. To me, I think the football game worked very well, and it got me thinking. I'm going to write more about this on a Sunday morning brief newsletter. I encourage everyone to subscribe in advance of that. Just running the numbers on Netflix, how much they could earn next year. The Street's only looking for $24 a share per share in earnings. Now, I can make the case for about $26 a share in earnings from Netflix next year as they roll out live sports, generate more advertising revenue, and you have games. We have Squid Games coming back out, more original content. I think you could easily make the case the Street is still too bearish on Netflix, even after a 92% year-to-date run.
Yeah, it was the bright spot in a dismal game to watch, quite honestly, between the Ravens and the Houston Texans.
Yes. All right, another Yahoo Finance trending ticker we're watching today is Toyota. What, you just thought we only track Tesla here? Nope. Toyota's global production declined for a 10th straight month in November, down 6.2% from a year ago. Still, its worldwide sales grew for a second consecutive month, boosted by demand in China and the U.S. And Brad, Toyota, I would argue, has become almost the forgotten automaker. And you have that Honda-Nissan tie-up. You have everything what's going on with Tesla and Elon Musk. You have General Motors pumping out a lot of good EVs. Ford stock under pressure. Story to watch for next year. And then you have Toyota, still a major player, putting out close to 7.5 million units this year, and they're trying to turn themselves around in many respects.
You think about some of the top-selling vehicles of 2024 here, and this is according to some Carvana data. Tesla, Chevrolet, Nissan, they really take the three top spots here. Toyota has one in the Camry, and of course that is their namesake car. That's probably the car that you get in when you order an Uber X, and we've seen a lot of those start to transition over to Tesla Model 3 vehicles as well. That mass-market auto manufacturer or manufactured vehicle from Tesla. And even as that takes the top spot for the top-selling vehicles of 2024, that just means Toyota, for the mass market play that they've had for decades, is starting to fall further out of alignment here, at least with some of the futuristic purchase ambitions that vehicle owners have right now.
Just compare the interiors of the new Prius with the latest Model 3. The new Prius,
not comparable.
It's not comparable. The Prius is it's not pretty. It's kind of it's bad. I mean, Toyota. I respect Toyota. They have a long storied history. It's just, wow, their autos just have not kept pace. Known for their reliability, but the interiors, the interior quality. I'm not saying Tesla makes amazing interiors because they've had quality issues of their own, but still, compared to what's coming out of General Motors and even a Ford, I mean, Toyota's got to pick up its game.
I mean, it's not going to woo you. Of course,
it gets from point A to B. You plug it in, it has 4 tires, it does what it's supposed to do.
Well, okay, so did Fred Flintstone's car. It had 4 tires.
That was a cool car.
And it got you from A to B.
Tires? Didn't it have rollers?
It had rocks. Yes.
Okay.
So at the end of the day, still, point A to point B, somehow you got there, even if you had to use the feet on occasion just to get you started. But at the end of the day, when you think about Toyota, it's amazing for consumers to have to go through the mental jousting from time to time of, wait a minute, this is the same manufacturer that rolls Lexuses off of its lines, and you get in a Lexus and you're like, okay,
fine.
This is fine.
They're fine. It's just fine.
It's not going to blow you away.
The Mercedes, they've all, Infinity's picked up its game. It's just,
Oh yeah, Mercedes is big time,
It's just.
Absolutely. All right, we're also taking a look at some restaurants. Perhaps you're getting in your 4-wheel vehicle or maybe 2 or 3 wheels, who knows? Anyway, if you're going to restaurants, here's what you should know. Evercore published a survey on consumer preferences, and it shows that fast casual restaurants, Sweatgreen, Cava, and Shake Shack have been among the biggest net gainers of consumer fans since 2019, especially with young people, and that's important. We'll come back to that. Meanwhile, Starbucks and Chipotle have been among the biggest losers of super fans over the past 5 years here. I'll leave the Starbucks chat to you,
yes,
but
thank you. Thanks so
I'll
much.
take a look at specifically Cava here and some of those that have gained fans. And I think they're doing it on 2 fronts here. They're really recognizing the customer lifetime value of some of those younger spenders that are coming in, and they're also making sure that they've got a digital first play so that it's not about sitting and grazing in the restaurant the same way that you would have before. It's about making sure that you can grab it, go, make sure you have quality of food that you've got access to as well, and the ingredients, and that it feels fresh, and that ultimately the digital side perhaps gives you a more streamlined experience.
Teens and 20-year-olds, they love leaving a place with a bowl. They don't want to eat a sandwich. They want a bowl, and they want it filled with 4 times as much food as you're supposed to be eating based on FDA guidelines. Kava offers that. It might be pricey, but the food is pretty good. Now, on the other end of the spectrum, Brad, you mentioned Starbucks. They have some work to do here. First of all, we all know that the prices for Starbucks need to be in line. That's something new CEO Brian Niccol is working on. You'll probably see more of his initiatives start to flow through in the first quarter of next year. But teens and 20-somethings just disenchanted with the mobile experience, according to this survey. Now, we recently talked to Brian Niccol. Myself and senior reporter Brooke DePalma asked him about some of the changes he will be making soon to improve that experience. Here's what he told us.
And we're getting ready to pilot some additional work on ensuring that our partners are set up for success to give a customer a great drink, right, in less than 4 minutes in store with that kind of marquee moment. You know, I'm calling it the moment of truth, where we hand you that drink, you see the grand apron, your coffee's coming right to you. We got to make sure we are set up so that our partners can execute that way. And that means obviously we got to have the right algorithm to support mobile order, as well as the right tools to support drive-through while we do this.
Brad, if Brian could get me a $2 iced coffee from Starbucks that doesn't taste burnt, I'm down. I think their stock price will head the other direction.
I don't think you're going to get $2 anything at Starbucks.
Well, no, under 2 minutes. Let me correct myself. Under 2 minutes, you get me that $7 iced coffee. I'll pay the $7. Just don't make the coffee taste burnt. Change whatever coffee beans there. You know, and this is even a Dunkin' Donuts problem. I got Dunkin' over the holiday yesterday. I mean, it's brutal. This stuff is undrinkable, Brad.
You know,
undrinkable.
It's also the investments in sustainability that all the companies are making right now, too. And I actually discovered this when I was up at Smucker's in Orville, Ohio, making the trip up there. And they're investing more in trying to make sure that they can get higher altitude beans as well, get that created even more. So it's something that all of them have to think about with climate change.
Well, they better think about it now. All right, straight ahead, we'll have the opening bell on Wall Street and a few top trading ideas from a market veteran, Kenny Polcari. I hear Kenny may have a recipe for us, too, for the holidays. Love his recipes. We'll be right back on Morning Brief.
There you're taking a look at the opening bell at the New York Stock Exchange. You've got Columbia Football ringing the opening bell, and at the Nasdaq, you've got the Make-A-Wish Foundation ringing the opening bell, kicking off today's trading activity here. All right, let's take a look at the markets as we've begun today's trading activity. First and foremost, let's take a look at the Dow Jones Industrial Average. Begins the day fractionally lower. Right now, we're down by about 0.4%. The Nasdaq Composite, as you see that calibrating behind me, over the past 2 days, net positive by about 1.4%. However, we begin this day 2 of the Santa Claus rally down by about 0.25%, we'll say. And then the S&P 500, you're seeing that still net positive fractionally, but to begin today, you're seeing that down by about 0.25%. So we've got some work to do to make up for some of the early declines out of the gate to try and add on to what we had seen in the first day of the Santa Claus rally just before the Christmas holiday. And now we're also going to continue to track very closely to see exactly what type of moves we need to say from mega cap tech stocks in order to perhaps give that a little bit more of the thrust in the engine for that Santa Claus rally. But as of right now, to begin today's trading activity, you're looking at some losses, some red on the screen at least. Flat as it may be for Nvidia, it is still hyper waffling as of this juncture, oscillating between gains and losses. Apple, right now, you're seeing that higher by about 0.4%. We'll dig into that a little bit more later on this morning here. Meta, perhaps that's another play that you're tracking here. One of the other Magnificent 7 stocks that's down by about 0.4%. So a lot of red to begin today, just a few spots of green. Also want to take a look at the sector activity as we begin today's trading activity. We are down across the board for the 11 S&P 500 sectors. Real estate, the worst of the performers, that's lower by about 0.7% right now. Even staples, you're seeing that in negative territory, but fret not. If you're taking a look at the year to date, of course, a little bit of memory good to hold on to at this time of the year where there is low volume, a lot of traders away from their desks, and so you're seeing some of the oscillation, at least in the beginning of today's activity here and now, as Luther Vandross would say. And then just lastly, they say check in on your friends, so let's check in on technology here. That's up by about 25% year to date, just shy of that, but it is down to begin today's trading activity by about 0.1%. Saz?
Oh, Brad, Luther Vandross. I mean, you're just speaking my language. Well, we'll take this offline. Oh, God, so good. All right, it's time now for today's strategy session. Stocks are lower to kick off the second day of the so-called Santa Claus rally. How does this bode for the rest of the rally and 2025? Joining us now is Chief Market Strategist for Slate Stone Wealth, Kenny Polcari. Kenny, as much as I want to talk to you about my epic cheese platter on Christmas Eve, I'm just going to push it to the side for a second. Maybe we'll talk about it after. It was just pretty special, but stocks first. I love what you wrote in your recent note. Maybe it was the day before Christmas. Investors shouldn't be FOMO-ized. Explain that to us.
Shouldn't feel like you're being, fear of missing out, right? You're FOMO-ized just because the market, especially these last couple of trading days, right, where moves can be exaggerated and they feel like they're missing out. And oh my God, like on Tuesday, the market ran, right? I think it surprised everyone the way it ran. This morning we're going to be off. And so they feel like they're going to miss an opportunity. They're not going to miss an opportunity. As a long-term investor, if you're already invested, you're participating, take your time and be patient with new money that's new york. Don't feel like you're being forced into doing something just because the market, is up and you feel like, oh my God, I missed it. You haven't missed it,
Kenny, as you think about the keys to the Santa Claus rally, in order for us to continue to see gains, and as we begin today in negative territory, but just fractional declines compared to some pretty sizable gains that we saw to kick off the Santa Claus rally just before the holiday, what are the keys to that trade?
Listen, it more than likely will get like a little push into the end of the year, right? But I think we're right here at the top. I think where we are 6,000, the mid 6,000s, like 6,050-ish, is probably where we're going to end up, right, as we move in. Because it's been a great year, right? You can't really complain about the stock performance for the year. But look, as we move into the next 4 days and then next week into Friday when it ends, that Santa Claus rally period, it's going to really set the tone for a lot of people, right? Typically, when we see that Santa Claus rally advance going into the first week of January, that sets the tone for the new year, right? But again, there's a lot going on, right? We've got a new president, we got a new administration, we got new policies that's going to be introduced. So investors need to kind of just sit back and watch this unfold, right? They're already invested. They've got money put to work. They're in a well-diversified portfolio. They shouldn't feel like, again, they're missing out, but they need to rush to get in. You absolutely don't. I think you got to let this play out a little bit. as you move ahead. But one way or the other, especially these last couple of trading days, I wouldn't be making any major decisions on your portfolio, based on what we see today, Friday, or Monday, Tuesday of next week. I would just kind of sit back and wait and see how it plays out.
Kenny, our chart of the day here at Yahoo Finance was looking back at the weighting of the top 10 stocks in the S&P 500 has never been higher, about 38%. I mean, these are some of the biggest names: Nvidia, Apple, Amazon, you name it. Do you see or do you sense from the folks that you talk to an appetite to buy more of these stocks in that first week in January when people start plotting out their portfolios for the new year?
I don't see that anyone's, people I'm talking to or investors that I'm helping manage your money, that people are going, the first week I got to get in, I got to buy more of those names. Not at all. In fact, what I would say to them is names that are stretched, and there are a lot of them that are stretched. You got to be patient. We already own them. They're part of your portfolio, so no need to feel like you missed it. Let's be patient, let them pull back. But on a pullback, when stocks go on sale, good names like those names, right? You're talking Apple, Amazon, Microsoft, IBM, names like that are great names to buy when stocks go on sale. And so I'm talking to clients, and when clients talk to me about, wanting to get into those names, it's about being patient. It's about getting in at the right time, not just getting in to get in.
And so with this in mind, what is the kind of valuation structure that you're, an assessment that you're applying, given some of the most overcrowded trades seem very, very highly valued at this juncture going into the start of next year?
Right. So again, we're not chasing them, right? They own them. And I would say to people, I would say to investors, take some of this new money that you're using and look for opportunities in maybe the sectors that have underperformed, or stocks in other sectors that are large cap, that are big names in those individual sectors that you're going to use as ballast for your portfolio to provide stability. Look, you don't, like anybody, you don't want to be overweighted in any one sector. I mean, if you're 20 years old, maybe that's one thing. But if you're 50 or 60 years old, then you absolutely don't want to be overweighted. You want to have a much more balanced portfolio. And so you're going to look for those opportunities. But again, like anything, don't go chasing stretched valuations, because as we know, trees don't go to the sky. At some point, it retreats. And that's kind of what we're seeing. That's kind of what we've been seeing over the month of December, right? Stocks are actually down in December for the most part. If you look at a lot of stocks on sale, and they're down 10%, they're down 12%, and those are the opportunities as long as they're good quality names and they're down only because of a market cyclicality versus the thesis changing in those stories. And I haven't seen, the thesis change in Apple and Amazon and Microsoft and Nvidia. The thesis has not changed. So on any weakness, we'd be putting more money to work.
All right, Kenny, we'll let you get back to the kitchen and do some more experimentation for that next recipe that's going to get tossed into the Substack. Appreciate it.
I think it was the oregano this morning. I saw a note.
Shrimp oregano.
Oh, oregano. There we go. Oh, man. Love it. I'll tell you about my cheese plate later.
I got to tell you, I agree with you. Starbucks, burnt coffee, I can't stand it.
I mean, come on. Can we just get a little bit of an Italian espresso?
I'm a Dunkin' Donuts guy.
Oh, man.
I'm a Dunkin' Donuts guy.
Dunkin's burnt too, Kenny. McDonald's. Give it a try. Iced coffee.
Or you guys could just make it yourself, right?
We could do
All
that.
your markets action straight ahead. Thanks so much, Kenny. Appreciate it. Stay tuned. You're watching The Morning Brief.
We're counting down to the new year, but also taking a look back at some big market moments of 2024 and how certain sectors performed. There are 11 S&P 500 sectors, in case you didn't know, and we're zeroing in on industrials. Yahoo Finance senior markets reporter Inez Ferre has been digging into this one for us. No pun intended there, Inez.
That's right, Saz. Industrials, XLI on the S&P 500, up 17% year to date. Take a look at this. Started out strong here, then went sideways for a bit, then it was up, came down in December, but you hit highs back in November, early November. That push-pull that we saw recently, that stop and go, is basically reflective of the markets on whether or not we would get a soft landing or not. There are a couple of themes that investors should consider going into 2025. One is the push for onshoring and reindustrialization. This includes bringing supply chains to the U.S., investments in everything from chip manufacturing to electrification. A second theme, big theme, being commercial aerospace. This involves aging fleets, servicing those fleets, planes that are lasting longer, having to fly those planes longer. That's driving up demand for parts and maintenance, which benefits companies like GE Aerospace, for example, which makes aircraft engines, and other suppliers and companies that also service those parts. And then the prospects of lower interest rates and deregulation with the incoming Trump administration. This has all been supportive for the industrialization sector, and part of the reason why we saw that big run up also after the elections as well. So if you take a look at some of the industrial players to see which ones really outperformed this year, this is the daily chart, but I'm going to put a year-to-date chart so you can see over here, as I was mentioning, GE Aerospace up 67%. You've got RTX, Raytheon, which RTX, look, 38% year-to-date. Defense contractor hit all-time highs earlier this year, recently. And then you've got Caterpillar, big machinery, like Sazi was mentioning. Caterpillar up 23%, also hit new highs recently. All of that onshoring, all of the industrialization, all of the commercial aerospace, all the aerospace in general, all of defense, all of that is very bullish for this sector, guys.
Inez, thanks so much for breaking down the industrials trade for us. Appreciate it.
Thank you.
Netflix betting big on live sports, making its NFL debut on Christmas Day, streaming 2 live games, and of course, one of those games featured a halftime show featuring Beyonce. Joining us now, we've got Santosh Rao, big Beyonce fan, and Manhattan Venture Partners head of research. Thanks so much for taking the time here with us. No doubt you tuned in just to see what was going on, what Netflix was bringing to the table here, to the field, and their 2025 programming slate. It's set to provide a strong tailwind for the company, at least it seems, by how investors are looking through. What's your assessment?
Absolutely. I think this was a home run as far as they're concerned. There's a big slate coming up next year. But before that, I think this was a great home run for the ad business that they have. I think it's really going to bolster their ad tier. And overall, I think it's going to pull in. It's all about scale. It's all about monetization. And I think this one was a hit in every which way. There was no buffering issue and all that stuff. So it went out clean and good response from what I hear, what I read. So I think net, I think this was a good thing, good initiative, good foray into real life sports. So I think this is good. I like it. I have nothing but good praise, and it should provide good tailwind going into 2025 after a strong 2024. So I think this is great in terms of everything, all things considered.
Santosh, I want to stay on Netflix. I'm doing a little work on the company. If you go to Yahoo Finance, click on the analysis tab, you can see that the average price target on Netflix is $838 a share. That's about 10% lower than it is today. And that is despite the company crushing earnings estimates every single quarter this year, stock up 92%. Can you still make a case? I hear what you're saying on the company's outlook, but that the stock is still undervalued. If they nail live sports, they nail Squid Games, they nail WWE in January, and this is a company potentially churning out billions of dollars on free cash flow, do you think the stock is still undervalued?
I think so. It absolutely is, because there's still a long runway ahead. They're just getting into live sports, and there's so many other live sports they can get into. Let's say cricket in India, then you got soccer and so many other areas that they still need to. So they're going to pull people into their ecosystem. So the sub growth is going to be strong. The revenues are already strong. The financials are pretty healthy. Yes, there's going to be some pullback, push. I mean, back and forth. But net, the secular trend is up and to the right. Just given all the fundamentals and also the competitive landscape is also not that strong. And they are well ahead of everyone. The others are still rationalizing costs and cutting costs, and there's slate issues, new releases and all that. So Netflix beats them on every angle. And yes, to a large extent, it's priced in, but there is a lot more to come ahead, because they are the only game in town in terms of excellent streaming services and the broad breadth of offering, the genres and everything. So whatever metric you weigh them on, they're just doing a great job, and they will continue to do it. So I would price it on a long-term basis. I wouldn't take a short-term view. They still have at least, I would say, at least 15-20% upside from here.
Santosh, I wonder, because this is not about them just loving sports so much. It's because they love the advertisers that come along with sports. And so what percentage of the amount of ads that typically go to some of the historic cable broadcasters or the larger rights holders of these sports would they need to be able to take away in order for that to be passed through to their financial performance and investors really see the full benefit of the different relationships that they're hoping to get on the marketing, on the advertising side?
I think that number is tough to pin down, at least for me at this point. But overall, I think what this does, it kind of gives them more scale. They need more content to pull people in. They need more stickiness, reduce the churn rate more and more. So I think all this is good. They're not going to take all the advertising dollars. That's a long shot. But at some point, they will get a sizable number to get the incremental revenue coming in from the ad business is going to be very sizable, very good for them. And they will, knowing Netflix, they will scale up very well. They will do a good job. So they start off low and then they really speed up. So their execution has been excellent. And you're going to see that more and more here as well. So exact number, how much they need to really make a mark, I don't know. But anything incremental is good. Their ad business is doing well. The ad tier is doing well. And more of that is even better.
Now, on one hand, Santosh, you have excellence in execution, Netflix. Then you have Intel over here. In fact, my hand just goes off the chart. It's out there somewhere. I mean, I was talking
way down.
I was talking to an investor in Intel earlier in the week, and we couldn't figure out, one, what ultimately happens to their foundry business, which is why they're really struggling here. And then number two, who leads the company? How dire is the outlook for Intel? And do you think all the downside is priced in here?
Yeah, I think to some extent, they can still go down, but I think most of it is priced in. They really missed the boat. I think the chips have evolved, the cycle they've evolved. They still stayed with the original compute business, but now it's more about training and AI and inferencing and all the other areas. They really missed out on all those things. So they need to catch on that side. So it's going to take a while. First of all, they need a good CEO who will execute a plan, a very coherent plan that will work. I think that's going to take some time. So I think if I had to take a bet reading about them and following them, I would say 2026 is really when you're going to start seeing some traction. But until then, it's really work in progress. They're still cutting costs, still cutting staff. They still don't know what they're going to do with the foundry business. They're going to spin it off. A lot of puts and takes there. So I think that it's going to take a long time. Meanwhile, the chip business is just moving on very fast, and they really need to catch up at a very fast pace if they really want to keep up with the rest of the chip business. But they have nothing more to lose. I mean, they're at the bottom now. They really need to, and it's a good asset, of course. Yeah. They have a great staff. They get great talent. They just need to get it together to kind of move ahead, and they will down the road, but not at this point. They still need a lot of work to do.
Santosh, thanks so much for taking the time here with us, and happy holidays to you.
Thank you. Same to you.
Thank you.
Great seeing you all.
Good to see you. Coming up, everyone, while stocks soared, Rolex prices plummeted all year long. We're getting into what's behind that trend next.
Investors are looking back on the year, and while your Bitcoin, gold, and equities are all likely ending 2024 higher, one investment isn't doing too well: expensive Rolex watch prices. Our resident watch expert, Praz Subramanian, has been watching this really all year long. Praz, trying to figure out, I mean, I know the value of your vast watch collection probably has gone up. You're a savvy investor, but like, what is happening specifically with Rolex prices?
Well, so overall, it has been a great year for the Swiss watch luxury industry, right? I mean, not really bad years in 2023 and 2022 where we saw steep drops, but this year the overall market fell 5.1%. And you mentioned Rolex, Brian, that they were down 5% this year. Patek and AP also down 6.5% and 7.4% respectively. Really interesting there, because these are the holy trinity of those Swiss watches. They're not doing so well, and I think it's because of the fact that they ran up so highly during the pandemic-fueled buying of these watches. But I want to point out, Brian, that a few brands actually appreciated this year: Bell & Ross, Tudor, and Cartier. Cartier in particular seen a remarkable strength this year. The past models at the Tank and Santos, these classic models, doing quite well. Good news for Cartier owner Richemont, which owns IWC, Panerai, and Vacheron. And I know, Brian, I think a nice Cartier would look really good on your wrist.
That's what he said he was gifting me, Praz.
Praz, I don't have your money yet, but is it a Tudor? Isn't it just a fake Rolex? Doesn't Rolex make Tudor?
They do. It's the sister brand, I would say. It is a good, a very respected watchmaker in its own right. It makes its own movements. Yes, they're owned by Rolex. About a price about a quarter to a half of what a Rolex watch runs, but very popular these days because people want. Actually, we've seen the data that actually younger, even millennial, and even some Gen Z people actually like luxury watches, and they're looking into it and buying them. So I was surprised to see that. Us Gen X guys probably not so much, but these days I think the watch industry is sort of being floated up by a lot of different subgenres and different cohorts.
It's interesting, Praz, because it seems like some of the most viral new watches that are coming out are some of the collaborations, some of the projects, either with historical watch companies that are saying, okay, we'll work with this new clothing designer or this new celebrity and come up with something. It seems like they're trying to generate fanfare that way. Is that, and the early elements of that, successful thus far?
We saw that huge collaboration with Swatch, with Omega, and Swatch also with Blancpain, just causing all kinds of hype and mania, people lining out the doors of Swatch to buy these watches. And I think on a lesser degree, you're going to see some watches that like other companies like Bamford who do with Rolex one-offs. You might see more and more of that as the brand sort of branch off into more younger and hype-driven brands as well.
Praz, when you come back in the office, you got to check out my Christmas gift. My significant other got me a new Seiko Arnie watch. It's like this hulking black watch that he wore in The Predator. I mean, it's solar powered. Well, I think it was only like $500. I mean, it's life-changing, Praz. You got to come and see it.
The Safari, I have it. I own that watch.
Really? I mean, hey, look.
I'll bring it in.
I mean, just great minds think alike. Praz Subramanian, good to see you, brother.
Thank you.
All right, that does it for the morning brief. Brad and I are sticking around, and we're going to talk about catalysts and market moves and lots of stocks. We'll be right back.
Welcome to Catalyst. I'm Brad Smith alongside Brian Sazi. We are 30 minutes into the U.S. trading day. Let's get to three catalysts that we're watching in 2025.
All right, first up, a more hawkish Fed drove stocks lower earlier this month. We'll talk to one strategist about how that sentiment could help drive a broadening out of the markets.
Plus, Bitcoin hasn't traded over 100,000 in over a week. Panic at the disco? We'll discuss what could drive the cryptocurrency to new highs in 2025.
And President-elect Trump has proposed tariffs on Canadian imports. We'll discuss the impact to the U.S., including in the oil sector. Stocks lower today after rallying earlier this week. The Dow falling for the first time in 5 sessions. Let's keep this convo going. With us now is Mike Dixon, Horizon Investment Head of Research and Quantitative Strategies. Mike, good to see you. You see a broadening out in markets. What's behind that call?
Yeah, when we look at what's happened this year with just the mega cap indices, there's just been an enormous divergence between the top of the market and the average stock. You know, common index to look at there is the equal weight index. When we look back to last year, we saw the same thing. So we're putting together 2 back-to-back years of some of the most dismal performance for the average stock relative to the market cap weighted indices. I mean, it even rivals back what happened in 1998 and 1999. And so as we look into next year, I think that large valuation gap and that performance divergence really sets up well for some catalysts to be able to drive that spread more closer and actually see the broadening out in the market that I think we've all been waiting for a while.
And so what are the areas of the market that are most apt or primed to see that broadening out occur for them first?
Yeah, I mean, a space I really like is the small and mid cap stocks. And when you look at the month of December, it's actually been quite terrible for the Russell 2000, especially compared to the top end of the market. And, you know, of course, we have Trump taking office here in a couple weeks. And when you look back to 2016, at this point, 6-7 weeks out from the election, small caps are up 16-17%. At this point, we're actually completely flat here in 2024 on that measure. And so I think a lot of the policies that the Trump administration is going to put in place from a deregulatory perspective, you should see a similar playbook to what happened in 2016. I think makes a really good setup right now as kind of an entry point, given the weakness we've seen in the month of December as we head into next year.
Mike, we've been talking about the Yahoo Finance chart of the day all morning long, really looking at how much or how large the top 10 stocks in the S&P 500 have grown as a percentage of the index, now almost 38%. Is it time to go underweight some of these big names like an Apple and Nvidia, Amazon? Underweight would be the equivalent of in my case, a sell. These stocks can't go up in a straight line again next year, can they?
I mean, you wouldn't think so, and you're right. I mean, we were sitting back here. I remember sitting back here in 2019 when the top 10 stocks made up roughly 20% of the market, and just thinking just how extraordinary that was. And here we are, 5 years later, roughly double that. I think there are a lot of opportunities, and we have some excellent catalysts in place as we head into the new year, particularly with the AI theme. That doesn't have to just mean the top of the market has to go higher, because we actually, when you look back the last 6 months, I didn't believe it till I saw the chart. Broad semiconductors and Nvidia are roughly flat over the last 6 months. But you've seen some of the phase 2 recipients. I think Broadcom just a couple weeks ago, their earnings report, an excellent example of this. They have that VMware integration, bringing software and services to the masses, and saw an excellent response with their earnings call just a couple weeks ago. You saw the same thing with Salesforce about 3 weeks ago as well. And so I think you're starting to see, some of the phase 1 recipients kind of being just the hardware side of semis to the phase 2 software and services, which, means in the tech space and in the AI, enabled space that you can begin to get exposure with some of the smaller companies in that space and move away from just the very top end of the market. I think that's a very warranted and good view heading into next year.
Even as we think about the different plays within AI and where we've seen the energy play, where we've seen the chips play, of course, which has held strong for so long, and we almost kind of need an updated "you are here" type of mall map in that AI trade. as we're thinking about the next area that's set to be a beneficiary, it seems like there's been more focus on the LLMs and the models, and then the applications that can sit on top of those as a more futuristic trade here. Who are some of those top names within the models that you think are starting to really be elucidated by traders?
Yeah, when you look at kind of the where we are picture, I think we are between first and second base at this point. Given some of those numbers I just referenced, I do think you have started to see a pretty firm transition away from just Nvidia, just semiconductors. I just mentioned Broadcom as a great example of that. It's still a hardware company, but software and services is where a lot of their positive commentary came around from their earnings calls. But you do have to be very selective. I'm going to give you a couple other examples that didn't work out too well, and that was Adobe and Oracle. We just saw those a couple weeks ago. Those stocks did not respond very well to their guidance, and I think the main reason there is some of the way that they're bringing AI to the masses. It's not a super unique offering, right? So with Adobe, you can kind of embed that AI in their software, but it doesn't really move the needle as much as something like Broadcom is doing. So you do have to be very selective amongst those names. You've seen other ones like Palantir as a great example that's been able to capitalize on this kind of software and services movement. But even if you are just going broad sector level, I think going inside of tech to a software and services is definitely kind of that phase two, and what's going to take us to go from in between first and second base to rounding third.
Yeah, we're going to be tracking Oracle closely. A little bit of a pullback, as you mentioned on the last earnings, but still up 64% year to date. Everybody talking about nuclear reactors, AI, and some of those themes look like they're set to prevail going into next year too. Mike, thanks so much for taking the time.
Absolutely. Thanks a lot for having me.
Certainly. We're less than a month away from the inauguration of President-elect Donald Trump, and there's plenty of regulatory change expected on the horizon. One sector that could see some of the biggest changes is cryptocurrency, and that sentiment has driven Bitcoin to all-time highs earlier this month, even though it has pulled back from those levels. Joining us now, we've got Brady Dale, who's the Axios crypto reporter here. Brady, great to grab some time with you, and happy holidays as well. As we're thinking about the major announcements and activations that could come forward under President-elect Trump once we see the changing of the guards in D.C., what are the first things that we could see mentioned and activated that would continue to thrust Bitcoin and crypto back to some of those new highs?
I think the thing that I'm watching the most closely is if the SEC decides to pull back on some of the lawsuits it's brought against big crypto companies, most particularly Coinbase. Actually, Coinbase sued the SEC and SEC has sued Coinbase. So if they cut deals around some of those cases and just sort of, knock them out of the running, then I think that would be a thing that the new SEC commissioner could do. The new SEC commission could do really fast, and I think that would have a big impact. So that's the first thing I'm watching.
Brady, do you think President-elect Trump and his team are in fact really crypto-friendly, or has the market gotten ahead of itself?
Oh yeah, I think they are for sure. Yeah, I mean he's appointed an SEC chair who was on the board of a digital asset lobbying organization. His Treasury Secretary has said good things about Bitcoin. JD Vance owns some Bitcoin. Yeah, I buy it.
Brady, as I think about strategic Bitcoin reserve versus a Bitcoin reserve that is publicly traded in the equity markets right now in MicroStrategy, I'm trying to best figure out and doing some mental jousting around just where we could see continuing purchases from MicroStrategy also go head-to-head with purchases from a government side, and how that would just add even more lighter fluid to the flame for BTC.
It would be wild. I mean, even if just remember, all that Trump has said he wants to do is hold on to Bitcoin that they bring in through law enforcement actions. He's not yet talking about buying it. Now, Cynthia Lummis, the senator from Wyoming, is talking about buying it. But I think even just the act of the United States saying, look, we are intentionally holding on to Bitcoin and we view it as an asset, not just something that we have for a year or so while we let cases work through the courts. I think that would be an enormous vindication for the asset class and would be a big boost to it. And then, yeah, if the United States government started buying, look out, that would be wild.
You know, Brady, just lastly while we have you here, a hot topic, and not the retail store that Sazi and I probably used to go to in middle school and
Love
high
that
school.
store.
But hot topic in the crypto landscape has also been some of the other coins, and XRP continues to come up. What do investors who are hearing more of the commentary, more of the chatter around XRP and Ripple need to know going into 2025, and how that could also benefit from a Bitcoin tide?
Yeah, I mean, I just really caution less experienced investors to be really careful about anything other than the big two. I mean, even the big two are really volatile. But Ripple has been wildly more volatile over time. It doesn't have a super strong use case. It doesn't really have a ton of people like actually using it in that many ways, or a ton of like real believers. So I don't know. I really urge just sort of normal people new to this market to watch for a long time before getting involved in anything other than the big two, Bitcoin and Ethereum. That'd be my main thought for them.
Brady Dale, Axios crypto reporter. Good to see you. Happy holidays.
Yeah, happy holidays to you too. Thanks.
Appreciate it. It has been quite the extraordinary year in healthcare, from the exit of CVS's CEO to Walgreens looking to sell itself to the tragic death of a top executive at United Healthcare. We'll dive into the year and the road ahead for the sector coming up.
We're ending the year with a look at how specific sectors performed. Yahoo Finance's Anjali Kemlani is taking a look at healthcare. Anj, what were the biggest catalysts for healthcare stocks in 2024, and what's ahead in 2025?
Well, Brad, we know that it's been kind of a rough year for the industry. Some big movers this year in the healthcare sector ending on a poorer note than in recent years, marking its shift away from being a defensive sector. And that's new for it. We know that, of course, healthcare has played a big role in 401k. So that's something to watch. Pressures coming from Congress to scrutiny by the FTC, and also efforts to control pricing. Those are some of the big themes this year and could remain in 2025 as we see a new administration come in. The healthcare sector had the worst performance among S&P 500 sectors in 2024, and biotech indices lagged. However, there were some outperformers driven by positive catalysts. We expect improvement in 2025. Macro environment and strategic selections remain key for potential upside and opportunity. So that's something that we heard from Barclays, and we're seeing that kind of sentiment across all notes from some of these investors. So let's take a look first in pharma. That's one of the big ones. No surprise that Eli Lilly, among the biggest gainers this year. With the weight loss market, it had a better product. It was able to ease shortage more quickly than competitor Novo Nordisk. And it also launched a direct-to-consumer platform and had other tie-ups with telehealth, making it a lot easier to get its product into the market. This is now Lilly's lead to lose, and it still puts it on track to be the first trillion-dollar healthcare company, as long as no one else takes that lead away from it. Now, another subsector is medtech, and volumes are finally up for surgeries now in a post-pandemic world as appointments are recovering. The industry has been struggling since 2020 due to the disruption of care, as well as loss of labor, and there's been some other macro pressures. So now, along with new technology, the trend this year is marking an end to that drought, and investors expect a slight downtick next year compared to this year, but still strong numbers, somewhere in the low to middle single digits. So we saw a note, of course, from JPM saying that procedure momentum remains robust, benefiting from favorable demographic trends like an older population and new products driving greater adoption and faster procedure times. So there you have it. Really good for a lot of big names also like J&J. So we'll have to keep an eye on whether that continues. And finally, one of the biggest losers of the year, CVS. A number of pressures from FTC scrutiny, activist interest, losing its CEO, and then the surgery volumes we just talked about being a negative pressure for the company as it had to pay out more in expenses for this. And the same is true for many of its peers. How the government manages Medicare Advantage plans is also another point, and whether or not Congress continues to target big PBMs, another area where CVS faces pressure, will determine the fate of the company and its peers in the coming year. So keep an eye on that one. Surprising how some of these bigger tickers that we tend to watch are doing so poorly and collectively against the S&P 500. That's something to watch for next year to see if that trend continues.
Good stuff right there. Anjali Kamani, thanks so much. Now time for one of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Eyes on shares of Apple as omnipresent Wedbush analyst Dan Ives raised his price target on the stock. He's lifting the target to $325 from $300, citing the iPhone 16 cycle, saying it's the beginning of a new golden era for Cupertino. That's, of course, where Apple resides. Shares of the tech giant have been creeping higher into the year now, and the company is closing in on a $4 trillion market cap, less than $100 million away at this point. I hear what Dan is saying. However, I want to just poo-poo a little bit of this call. Good analysis by Jonathan Krinsky over one of BTIG. Follow him all the time. Last week, Apple closed for his fifth straight week of gains. Jonathan's work says anytime that has happened, the next 4 months of return, I would say the next 4 weeks of returns have been negative both times. Average decline of about 6%. So you can clearly see everybody's really excited about Apple. I think Dan makes a good point on AI being achieved, but you have to think about it. Is this another big cap tech stock that has all of its good times for next year effectively priced in? Of course, Brad, you're not seeing Apple necessarily making money off of AI-related gadgets just yet.
Yeah, you know, the other thing that really kind of jumped out to me is actually one of the points about China specifically here. Within the note, he talked about the super cycle that we could see emerge within China. And of course, as you think about what this means, especially within the Chinese consumer as well, they believe that there are 100 million Chinese iPhones in the window of an upgrade opportunity alone for 2025. Now, here's where IDC is actually putting and has already put some cold water out there. There's been a lot of robust growth for Android in emerging markets and in China. That's not good for Apple's OS. And of course, some of the new features that they've put out. Coming up, everyone, we're talking the oil outlook for 2025. Stay tuned.
Are investors sitting on a profit gusher from the oil patch in 2025? Well, it depends. Wall Street is only forecasting crude oil prices will range from $76 to $65 a barrel next year. President Trump's plans for tariffs on Canada and Mexico could potentially send prices rocketing higher. Lippow Oil Associates President Andy Lippow is here. Andy, always nice to get some time with you here. I think investors are still trying to figure out if we get more domestic drilling, if President Trump pushes through some of his agenda, what do you think it means to oil prices? And then secondarily, what does it mean to some of the oil majors like an Exxon?
Well, thanks very much for having me. Trump has the philosophy of drill, baby, drill, and their administration is expected to ease regulations enabling oil producers to drill on a more efficient basis by getting permits sooner rather than later. However, setting that aside, if we just look at the oil market sitting at around WTI of $70 a barrel, this is really the biggest impediment to substantial growth in the oil patch. We're already going to hit a record of about 13.2 million barrels a day of U.S. production this year. It's forecast to rise to about 13.5 million barrels a day next year. But if we look around the world, the oil market is oversupplied going into 2025.
We've already got record production out of Canada and Guyana, as well as some new supply coming, and that has come online from Argentina and Brazil that you mentioned. What has that done to the mix here in terms of just the inputs and different sources of production around the world, and how that could have also some geopolitical implications?
Well, it certainly has pressured OPEC Plus to delay and defer the restoration of their voluntary production cuts, which amounted to about 2.2 million barrels a day over 2 years ago. If we look at OPEC Plus's spare capacity, it's now well over 5 million barrels a day. And as a result, the oil market is not particularly concerned about supply over the next few years, especially in an environment where Chinese oil demand growth has disappointed, especially in 2024. If we look back to January, it was forecast to grow about 700,000 barrels a day. Here in December, the forecast for Chinese oil growth has dwindled to about 180,000 barrels a day.
Andy, maybe I'm watching too much of Paramount's new show, Landman. Whatever it is, mergers and deal activity in the oil space is top of mind for me. The last big deal we had, of course, Chevron purchasing Hess for $53 billion. Is there more consolidation you see happening in the industry, in large part because of a friendlier Trump administration?
Well, I do expect that consolidation is going to continue. There are not many large players left, but the oil producers need the consolidation to improve their efficiency, which we're certainly seeing on the drilling front, doing more with less rigs out there. And of course, they're looking at returns to shareholders, given that WTI prices are sitting at around $70 a barrel.
Andy, I wonder here, and I was looking through your notes to see if there was any mention of this, but the Keystone XL pipeline, this is something that Biden had fought back against, and now it seems like President-elect Trump, when he gets in office, is going to try and restart talks, conversations, and then ultimately bring that to fruition. What are your anticipations around that?
Well, the Trump administration may be very likely to issue a permit for Keystone XL and its expansion. But I think if I look out in the field and how much the cost of construction has increased over the years, combined with a new expansion of the Trans Mountain Pipeline, adding capacity out of Canada to the Pacific, I think that the market is probably in the near term going to be reluctant to proceed with any construction, especially if they're faced with local opposition along the route.
How much do you think that would add to the deficit, if anything?
Well, I'm not sure that Keystone XL itself will add to the deficit because the construction costs will be borne by the producers or the shippers of record. But I think what I am concerned about is if Trump enacts his tariffs on Canada, as well as Mexico and the rest of the world on energy, that adds, of course, to the cost of energy here. And ultimately, that's going to impact on consumer spending, as well as some tax revenues to the government.
Andy, thanks so much for taking the time to. Happy holidays as well.
Thanks for having me.
Let's do a quick check of the markets here as we're taking a look at the major averages, the Dow, the S&P 500, and the Nasdaq. The Dow right now lower by about 0.2%. The S&P 500, you're seeing that lower by 0.3%, and the Nasdaq Composite tech-heavy average down 0.2%. That's it for Catalysts, everyone. Stick with me. Coming up at 11 a.m. Eastern Time, we've got wealth dedicated to all of your personal finance needs. Stay tuned.
The Bipartisan CHIPS Act passed by Congress under the Biden administration focused on incentives for domestic chip production. President-elect Trump has called that CHIPS Act, quote, so bad during his interview with Joe Rogan. He's been very critical of the implementation of that. And Trump has approached competition on chips by threatening tariffs on China. Now, amid those threats, Beijing recently launched an antitrust investigation into Nvidia. Joining us now for the road ahead here for chip makers under the incoming Trump administration, we want to bring in Patrick Moorhead. He's the founder and chief analyst at More Insights and Strategy. We also want to bring in Chris Miller. He's author of Chip War. It's great to have you both. Patrick, let me go to you. When we talk about how critical President-elect Trump has been of the CHIPS Act, he wants to obviously make changes. Lots of questions about what exactly the pathway forward is going to look like here for the industry under Trump. Is it a positive picture or is it a negative one?
I think it's going to be net positive. I mean, Trump doesn't want to be the president that tanked the tech stock market, and he certainly could do that if he puts any weight on the chip stocks that have been a tremendous part of the growth over the last 4 years. And I think for people have to keep in mind that with him, it's all about the art of the deal, going back to the book that he wrote back in the 80s. And I think this is all about a negotiation. I think it's all about getting companies like TSMC and Samsung to create more jobs here in the United States. With all of the advanced semiconductor manufacturing leaving the United States or most of it, Trump's trying to get the best deal to bring it back in. I do not believe he will tank the stock market or major industries to make that happen.
Well, Chris, it's really interesting because we know that the origins of the CHIPS Act came under Trump 1.0, and then he says the way it was enacted was so bad, as we mentioned coming into the segment. So based on your reporting, what do we know about what Trump's 2.0 CHIPS policy could look like his second time in office?
Well, I think that's being defined right now by the president-elect and his incoming administration. They've talked about tariffs as a potential tool. And of course, Trump imposed a whole lot of tariffs during his first term. And I think we should expect that they carry through with at least some of these threats. I think Patrick's right. There will be negotiations. There will be deals cut along the way, but you only get to deals if you build up leverage first. And I think that's exactly why the new Trump team is threatening tariffs, not just on close allies, but also importantly on China. And it's China that bore the brunt of Trump's tariffs in his first term. And I think it's China that's very much in target right now as the Trump team maps out their tariff strategy for the upcoming term.
Patrick, it's very much a wait-and-see mode, although many of these chip companies are acting now, or at least talking about maybe that strategy. We're looking to hear a little bit more this upcoming earnings season. But I'm curious, in terms of the potential bottlenecks that could be created from a supply chain perspective, is that something that investors should be worried about? Or I guess to what extent or when should they then be more worried about the impact of that?
So first off, I just want to say that I don't think China is going to be the major issue here. I think it's more TSMC, but I'll focus in here on China. I think investors should be looking into every one of their investment plays and seeing if they have a supply chain resilience plan. It's a what if. I will tell you the assemblers of PCs and servers and networking equipment are actively engaged in finding ways to move manufacturing out of China. I think China has a lot of leverage here. There was some discussion earlier about that leverage. I mean, China could maybe slow roll a 30-cent PMIC, power management integrated circuit, to hold up shipments of $100,000 cars here in the United States. They can also play tit for tat like we've seen, like they did earlier with IBM and then with Cisco, and then now we're seeing with Micron. So China holds a lot of the negotiating power here that's related to semiconductors. So we can't forget that. Again, this is all about a negotiation. Trump doesn't want to tank certain markets. And the other thing he doesn't want to do is he got elected based on bringing inflation down. And we all know that tariffs will increase prices of final goods, particularly putting a 60% tariff on goods that come from China. You can imagine everything getting a 60% tariff would absolutely raise inflation here in the United States, and the Trump administration is not going to do that.
You mentioned the tit for tat, Patrick, so I want to stay with you because we know that Beijing has launched this antitrust investigation into Nvidia for anti-competitive practices. Let's just get to what investors want to know. Is the precious market darling Nvidia going to be okay regardless of any potential policies to come under Trump 2.0?
Yeah, so all or most of Nvidia's growth has been in the hyperscaler data center, and pretty much every one of those cards and those platforms have been banned from going to China. There was a wave of tuned down Nvidia parts that went in there. So Nvidia has already been reduced in China. I mean, sure, it could go from 10% to 0. I don't see that happening. So net, I don't see a big impact. There is some packaging and assembly that happens in China, that advanced CoWoS and CoWoS 2 packaging. And that's something I just need to do a little bit more research on what they do with it, because what that could do is raise the price of those technologies where Nvidia cards are made, assembled, or there's packaging done there, which could also be applied to tariffs.
Chris, what about the industry-wide implications or waves from this? When we take a look at what's happening here with Nvidia, how worried should some of the other larger chip makers like an AMD be, just in terms of what this could potentially signal could be coming down the road for them?
I think Patrick's right. Nvidia is much less exposed than the typical chip maker, with a smaller share of its revenue coming from China. Others have a much, much larger China revenue share. Some companies, it's as high as 50%. And we've seen China take steps not only against Nvidia, but other U.S. companies too. A cybersecurity investigation threatened against Intel earlier this year, a different investigation against Micron last year. And I think China is signaling it's willing to restrict access to its market as a retaliatory tool against U.S. firms if the Trump administration tries to ramp up pressure.
All right, guys, we got to leave it there. Thank you both so much for joining us with our sector spotlight on chips. Patrick Moorhead and Chris Miller. Thank you. U.S.-China relations are top of mind heading into Trump 2.0, as the president-elect has proposed an additional 10% tariff on China, while also threatening levies as high as 60% on all Chinese goods. This all comes as China's economy continues to be under pressure, with an unexpected slowdown in retail sales, adding to the macro backdrop confusion. For more on how Trump policies could impact this relationship, we've got Shahzad Qazi, China Beige Book's International Managing Director. Shahzad, it's great to have you on here. So the Chinese economy is still clearly under pressure. It's clear that these tariffs are coming to some degree. How much power does Beijing have in tariff negotiations given the struggling macro backdrop in APAC?
Yeah, look, I mean, the Chinese economy is certainly weak, not catastrophically so, however, and that's a very important point. I think rather than just looking to negotiate, what Beijing is going to try to do is hit back and retaliate, I think, as hard as they feel that they need to, depending on what the tariffs look like. But I think even more importantly, what they're going to be focused on over 2025 is making sure that the tariffs are being met with as much monetary policy support and I think as much fiscal spending as is needed in order to counteract their impact. And I think a lot of that would really just come down to heavily supporting the industrial economy, the manufacturing economy in China.
Shahzad, what do you think, and we're showing pictures right now of President-elect Trump and Xi Jinping in the past, when you come to how this relationship is likely to play out over the next 4 years, when you talk about the likelihood of tariffs, maybe to the extent of the tariffs that could potentially be implemented, and then you also have President Trump extending the inauguration invite to Xi Jinping, which is pretty substantial in and of itself. What to you does that signal about their relationship between these two world leaders, and what investors should take away from that?
Well, so, they've done this before. We've already seen round one, and round one ended, of course, with a trade deal. And that's what markets are getting very excited about. They are very convinced that there is going to be another deal. But I would caution very, very heavily against that. I think this time around, the Trump team is coming in with a far more aggressive agenda. A lot of the press reporting between there being a lot of daylight between what the incoming Commerce Secretary would like to do versus what the traditional trade folks want to do, I think it's overplaying. There's a lot more similarity. There's a lot more convergence of opinion than anything else. And the Trump team is coming in understanding that the president wants to go hard, and that's what they're there for. They're there to implement policy. This is not like Trump 1, where you've got a bunch of staffers who are going to be fighting constantly, trying to convince the president to go in different directions.
But in terms of the reaction function of Beijing, is there sort of a requirement now for Beijing to finally issue some stimulus to consumers given the pending threat of tariffs?
They're not going to, I think, go big on the consumer side at all. It's sort of almost antithetical to their ideological convictions, at least so far. Plus, I think what they want to do is make sure that they're supporting their companies. They want to make sure that they remain a very important dominant power as far as manufacturing is concerned. We hear about new productive forces all the time out of China now. They want to be a major player in high-tech manufacturing. And so the focus of their stimulus policies is going to predominantly be on the industrial side, I believe. And of course, the real takeaway there is, does that exacerbate the very trade problem that's inviting these tariffs to begin with?
Does it, do you think?
I think so. Absolutely. Look, Chinese overcapacity is here to stay. It's not going anywhere. And so if they keep doubling down on this as they have, it's only going to create more and more, I think, problems. And it's not just going to be an America-China story anymore. We've already seen emerging markets taking action. So Chinese overcapacity, I think, is here to stay. And more tariffs and more trade wars across different countries vis-a-vis China, I think that's the future we're looking at.
So then, can the Chinese market, given that, coupled with the fact that we are also seeing some of these econ data, Maddie referenced the retail sales number that was out this morning, obviously very weak and emphasizing some of the challenges facing the country right now. Can the market side of the story when it comes to China, can that still be okay, given all of these challenges?
I think the market might get some positive surprises. Look, if you look at the property market, it's clearly showing some signs of stabilizing at a low level. But those declines that we had gotten so used to, it seems like there's some breathing room finally in place there. These retail sales numbers are not altogether, by the way, that bad. We saw some retail weakness. We saw more services weakness in our November data. But that could turn around as more stimulus comes along the way. There could be incrementally somewhat better numbers, even if they're not magically, better numbers. So I think the market may actually have some positive China stories to pull on next year. And of course, the other big one I should mention is, the improvement in corporate borrowing, which we saw after a very long time. So business confidence actually may not be as dour heading into the end of this year, beginning of next year, as currently the consensus has it.
All right, Shahzad Qazi, always great to get your insight. Thanks so much for taking the time.
We want to take a look at the critical issue for voters this election, which included housing affordability. Our next guest says that seniors are the secret key to the market. 60% of all homes in the U.S. owned by people over the age of 60, and that is a 60% increase since the year 2000. Joining us now with her outlook, Meredith Whitney Advisory Group's CEO. Great to have you on here. So obviously seniors are staying in their homes for longer. What reaction function could the policy look like to navigate the challenge that presents for home affordability?
Well, I think what is happening is, so 60% of U.S. homes are owned by seniors. Under 10% of U.S. homes are owned by households under 40. So the affordable housing is occupied by seniors who are aging in place and want to stay in their homes for longer. what that means is that I think a big push in what you're starting to see out of Housing and Urban Development and other federal agencies is a push towards aging in place more safely, more affordably. So I think you're going to see, instead of first mortgages be the big active market, second mortgages and home equity lines of credit, home equity, shared home equity investments, and you're going to see a big upgrade cycle with seniors aging in place. What that means for affordability is I think you're going to see new homeowners continue to struggle and stay renters for longer.
Meredith, when it comes to some of the past predictions that you've given, a 10 to 20% decline that you're expected to see here in home prices, when you come to factor in the Trump era policies or what that could look like when it comes to deregulation, when it comes to tax cuts, how does that then influence the trajectory that we're going to see of home prices and maybe how quickly we could see that drop?
Well, I actually think, whereas I thought home prices would have to decline because seniors would be forced to sell, affordability across the board, particularly for seniors, is difficult because you've had cumulative inflation from higher homeowners insurance, higher property taxes, and you see seniors really struggling. So, in fact, seniors have taken out more debt at a faster rate than any other age cohort, and now they hold 44% of total home equity outstanding. That's up from 19% in 2004. So you see seniors really struggle. So I think that having them be able to tap into their equity is going to be something that the Trump administration really pushes for. And there's 35 trillion of equity, and over half of that is tappable. So I don't think there's a lot that can be done because there aren't a lot of affordable options for seniors. Only 1 in 10 seniors can afford assisted living. So if you're on Medicaid, you can go into nursing homes. But if you're not on Medicaid and over, almost 80% of, almost 90% of seniors are not on Medicaid, their options are much more limited. Until you get those seniors to move, which they're not doing, the affordability factor then rests just with new home build. And so the administration can focus on that. But I think the easier route for the administration is going to be focused on this incredible amount of money that seniors can tap into that will aid with aging in place.
I do want to pick up on what you just mentioned, though, about new home build. And one of the policies that could be a headwind for that is the crackdown on immigration in particular. How are you thinking about the impact that specific policy could have on the price of homes moving forward?
Well, there's no doubt. And I think that, the cost of building, the cost of land is still incredibly expensive, and the cost of labor is really expensive. And you nailed it. So one of the biggest challenges to home building and renovations is finding the people to do that work. So I think the administration should think very seriously about immigration. And what they want to do is make sure that that immigration is legal, and it seems as if they're focusing on just deporting criminals. Now, that's a small number of immigrants. There are a lot of immigrants that are, the majority of immigrants come here to work hard and create a better life. But the labor is a problem across the board. Labor is also a problem, getting back to seniors, at home care, home healthcare providers are largely filled by immigrants. And so we have to have a very, very strong immigration policy to encourage immigration, particularly for skilled workers.
Meredith, how critical is that just in terms of if you take a step back and just overall just effectively encouraging new construction and implementing that in a way that is that works and is viable going forward? How critical is that in the piece of all this, and ultimately what that tells us about the timeline, quote unquote, on trying to solve the housing crisis right now?
I think the timeline, this is why I focus on realistic options. The timeline on new housing build is long, and a lot of that is land-based. And I was just with a delegation from Nebraska looking at manufactured housing, doing a manufactured housing tour. And manufactured housing is cheaper than stick-built housing, any day of the week. But the problem is, if you factor the land in, that's where it gets really expensive, let alone the labor that we were talking about. So one government program is to deed over government land, federal land, state land. States own a lot of property that they are not fully using. They shouldn't be asset aggregators. There are going to be options there. So land is a big factor. Labor is also a big factor.
All right, Meredith Whitney, always great to get your insight here, especially taking the time here on Yahoo Finance. Thanks so much for talking to us here this morning.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the tech and hype around artificial intelligence has been the big driver of markets this year. So how can you think about investing in the space in 2025? We'll discuss that. Plus, ETFs have had a record run in 2024. We'll discuss the outlook for the assets heading into the new year and a holiday gift guide. Are you looking to return a gift? You'd better check the deadlines and the return policy. We'll break down some of the retail hacks with an expert. All of that and more during today's show. But first, we take a look at some of the market action. We are 90 minutes into the trading day. We are amid this holiday abbreviated trading week, and the markets were closed yesterday. Stocks, though, lower today after rallying to begin this week here and kicking off the Santa Claus rally, but turning now to one sector that has been the market star this year. It's been technology. Artificial intelligence has been a key part of the tech story in 2024, helping to drive the sector higher, up nearly 25% this year. And the AI story is set to continue in the new year, but perhaps with slight differences here. Here with more on what to know about investing in tech, we've got Kimberly Forrest, who is the Bokeh Capital Partners founder and chief investment officer. Great to have you here with us this morning, and happy holidays to you. As you think about the trends that could continue to drive the tech trade in 2025, what are some of the bullet points that investors need to keep in mind?
Sure. Well, let me just briefly tell you about me and maybe why you should pay attention to me. I actually was a software engineer that did AI back in the 90s. And whenever I moved into the current industry, I was a sell-side analyst covering software stocks starting in 1999. So I know a thing or two about tech investing and bubbles. And I wouldn't say this is necessarily a bubble, but I think you really have to be careful about just throwing money at the same old places that you did last year, because technology needs different things as it rolls out. And this is going to be a longer rollout than anybody who's currently investing and has won so far is really prepared for, or at least that's my opinion.
A handful of companies that made it through the dot-com bubble and were able to chart their own way to recovery, not only in the share price, but also even furthering the shareholder value, the actual size and scale of their businesses. Some of those are still around for this generative AI era now. What are some of the core characteristics that you see between companies that were able to make it through the dot-com era and those that are able to navigate through successfully this generative AI boom?
I have to tell you, that is the best question I've heard on AI so far. Thank you for that question. So here's what I always look for in technology is what problem are they solving and what price is the solution, and does it merit to be solved by technology. Back in the 90s, technology for AI was unbelievably expensive. We didn't have the data we needed. The machines themselves we spend a lot of money on them, but we have big machines now, right? So we're getting bulk purchasing, not the artisan kind of machines we used then. So I have to, scratch my head and say, are we solving problems with this, or is it just cool? And right now I have to say, the products that I've seen are just cool and not necessarily solving problems, and certainly not at a price that we can afford. JP Morgan did a real quick survey on how much the top 4 companies have spent so far through August. So that's Microsoft, Alphabet, Meta, and Amazon. And it's $142 billion. That is a lot of money. And I don't see a problem that is being solved for that merits that cost.
So how can investors then grade the spends versus the timeline for it to come to fruition and the return on that investment?
Sure. Well, pace yourself. And understand that the technology is going to mutate a little. Right now, Nvidia is the big winner, and they have a GPU chip. But it seems like Broadcom has a solution for another part of the problem, which is inference. So maybe you want to look for companies like Marvell and Broadcom that are adding to the solution, right? So you want to do that. And I wouldn't kick Nvidia to the curb. You know, they are still doing very well, and their product is needed. It's just that you may lose momentum investors there as people have other choices and other directions that the spending is going to go in. So right now, Nvidia really moved higher because it was a momentum investor's darling, but also because the underlying product is very necessary for the next generation of computing.
Kimberly, really actionable advice and valuable insights for our viewers. Appreciate it. Thank you.
Thank you.
Certainly. As we wrap up 2024, we're checking in on what's driving the utilities sector. Joining us now is Yahoo Finance senior markets reporter Inez Ferre. Hey, Inez.
Hey, Brad. And utilities is usually that sleepy corner of the market. And keep in mind that it finished 2023 last year as the lowest performing segment. But this year, totally different story when it comes to utility, especially on the back half of the year. Take a look at our chart on the sector action, and you're seeing that utilities is up 20% year to date, and it hit new highs during the fall. Look, a lot of things are happening in this sector. This sector really shifted in perception because of two central themes: artificial intelligence, like what you guys were just talking about, and also the energy needed to power AI, along with the electrification trend in the U.S. and abroad. Keep in mind that electricity demand has been relatively flat for years, but U.S. power demand is expected to grow at 4% next year. It's the highest rate since 2027, and demand is expected to grow from there as well in the years to come. So if we just take a look at the best performers within the utility sector, I'm going to pull up this, which is the electricity generation chart that we have for you. Vistra up 271% year to date. It is the number 2 year to date biggest gainer on the S&P 500. This is a Texas-based company. This company works on generating electricity and power from natural gas, nuclear, solar, battery energy storage. But really, it's the nuclear play that Wall Street has been very, very enthusiastic about this year, and companies that are working with big tech, because these are really seen as sort of big tech proxies. Constellation Energy is another big one, up 95% year to date. Remember that Constellation earlier this year had announced a deal with Microsoft to restore the 3 Mile Island Unit 1. So that was very big for the company. And then another big performer this year, up almost 20%, NextEra Energy. This is a company that also works on different types of technologies for energy generation. But really, it's that enthusiasm over AI and that proxy to big tech that has sent a lot of these stocks higher, Brad.
All right, nearly 19% gains year to date for XLU, sleepy area of the market, as you mentioned, Inez. Not too shabby. Thanks so much.
That's right. Thank you.
In the last trading days of 2024, we're taking a look at the record-breaking $1 trillion in ETF inflows this year, 2024. We're joined now by, and on that record, we can expect perhaps a few things for what we can expect in 2025. We've got Aniket Ulal, who is the head of ETF data and analytics at CFRA, as part of this week's ETF report brought to you by Invesco QQQ. Aniket, great to have you here with us. So just first, the sheer size of flows that we've seen into ETFs this year, what do you attribute that to?
Good to talk to you again, Brad. When we talked the last time, we were talking about ETFs potentially exceeding the $1 trillion. We're now past that. It's actually, when you have inflows of this magnitude, it's really all categories that contribute. But I'd highlight a few things. One is the growth in active ETFs. We've seen non-indexed ETF assets grow significantly this year. If you go back 10 years, the percentage of active as a percentage of total ETF flows was less than 5%. Now we're looking at almost a third of our ETF flows being into active non-indexed funds. So that's certainly a big driver of growth. Another one is crypto ETFs. We saw earlier this year in January, spot Bitcoin and ETFs launched for the first time. Those now in total assets are rivaling gold ETFs, which is quite significant. So there's multiple categories contributing. Of course, the traditional indexed ETFs also contribute, but it's all of these things together, get you over the $1 trillion mark.
Of the themes that are shaping up and really set to potentially prevail in 2025, do you think that sets up for another record year of inflows into ETFs? And what would those themes be that do need to play out?
In terms of flows, we think $1 trillion is a hard act to follow. I mean, this year was a perfect storm in terms of having very strong equity market performance. We had a lot of money moving in from traditional mutual funds into ETFs. So our projection for next year is that we expect ETF flows to be somewhere between about 500 billion to $1 trillion. That's a wide range, but probably not matching what we saw this year. That's not a bad number. That's still a very healthy number in line with what we saw 2 years prior. So it's still a good outcome, but it's probably difficult to match $1 trillion. One wild card, of course, is whether the SEC approves ETFs as a share class of mutual funds. Many large mutual fund managers have applied for that possibility, having ETFs as a share class of the traditional funds. If that gets approved, then $1 trillion is possible. Otherwise, we probably think we'll see a healthy number somewhere between 500 billion and $1 trillion next year.
And there are some ETFs that stand out in your mind versus others here. Take us first into your financials play, because it seems like that's been a common denominator for many of the strategists that we speak with.
Well, we have a team within CFRA called Washington Analysis that focuses on policy. And they, in a report recently, they said if you throw a dart at the financial sector, you'll likely hit a company that's going to benefit in Trump 2.0. And really, that's a deregulation play. We see both in the banking, large banks, as well as regional banks, and in other sectors like payments. We expect regulation to be lighter. We also expect M&A activity to be higher. Capital adequacy requirements on large banks, what's referred to as the Basel III endgame, probably won't happen. So, all of these factors together mean you're probably getting a sector that's going to benefit from deregulation, benefit from more M&A activity and more capital markets activity. So overall, we are bullish on ETFs like KRE, which is a regional bank ETF, RKF, which holds a lot of kind of payment firms, and KBWB, which is a large bank ETF.
While we have you here as well in the time that we have left, you're also focusing on some software ETFs too, which has been particularly interesting, especially as we look at their plays for generative AI and to get some of that generative AI trade here. Where on an ETF play side could we see the software landscape really be a beneficiary?
It's really interesting if you look at it from an ETF perspective. Before the election, semiconductor ETFs were really outperforming software. If you look at SMH, it was almost 30 points of better performance differential than XSW, which is the software ETF. Since the election, we've seen a reversal. SMH has kind of been flat, whereas XSW has really been, it's up about 13 or 14% since November 5th. We think that's driven by multiple factors. Our fundamental analysts have looked at, for example, software spend. We expect 14% increase in software spend next year, much more investment in agent-oriented AI investments. We think that's a big theme next year. And of course, the rate environment is going to be much more favorable to tech. We know that software does well when rates are being cut. So all of these factors we think are tailwinds for the software sector.
Annika, great to see you. Thanks so much for joining us here for the conversation once again.
Thank you.
Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned. We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks falling as trading resumed after the market holiday. Traders holding on to hope for a Santa Claus rally following back-to-back gains earlier in the week. A look at the meme trade. Shares of GameStop extending gains as a vague image post on X from Keith Gill, also known as Roaring Kitty, helped lift the stock. In retail, Chinese e-commerce giant Alibaba and South Korean retailer E-Mart are setting up an online shopping joint venture. As for deals, Japan's Nippon Steel extends the closing date for its purchase of U.S. Steel. The closing date now revised from the third or fourth quarter of 2024 to the first quarter of 2025. And that's your Market Minute to keep you on track with the news that you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More wealth when we return. Sometimes a holiday gift just misses the mark. According to the National Retail Federation, Americans are expected to return 17% of all holiday purchases this year, representing, get this, $890 billion. It can be hard to know the best way to return something. Luckily, we have Gaurav Saran, who is the ReverseLogics.com CEO and retail expert, here to help. Great to have you on, and happy holidays to you. Okay, so where do you start if you need to return one of those gifts that you got? Maybe it's wrong size, maybe it's a wrong person for this one. Where do you begin, and what is the ultimate way to get it done right?
Well, Brad, first of all, thanks for having me. And you're right, that ugly Christmas sweater that may have come by. The first place you start is you want to make sure you look at the return policy. And if you have kept your receipts, go online, see if the retailer is offering you exchanges, but do pay very close attention to return windows. A lot of retailers change their return windows during the holiday seasons. Check to see if there's any restocking fee. Also make sure that you have looked at things like warranties if it's electronic items.
And so all of these things considered, and these are some really good tips that we've got here up on the screen for our viewers, as we think about what this also holds for just what the mindset of the consumer is right now. What can you extrapolate from the returns and the way that people are purchasing that actually makes those returns a lot easier than when we were probably growing up?
No, absolutely. First of all, the holiday season, we've already had staggering returns. Returns are up about 6.7. Sorry, the retail value of products has hit almost $890 billion. From the way we behave in terms of how we are used to returning product, most consumers are buying products knowing very well that they'll be doing things like bracketing. You buy 5 or 6 items knowing very well that you're going to return 1 or 2 of them. Or you are buying products such as that ugly sweater that you're looking to return, where it's called wardrobing. So we're very used to that, just in the way since COVID, where consumers are so used to easy returns experience. Now, what retailers have done is they need to make sure they offer a very nice and easy returns experience, simply because 67% of all products returned need to have an easier process for them to come back. So those are some of the factors that are making sure that, as we're behaving in the returns journey, all the returns are easy for us to return. And retailers want to make sure that the customer experience is really, really good. Most retailers are seeing about a 25% increase in customer satisfaction with a good returns experience. And at the same time, they want to reduce the loss from the returns. So they're investing in technology to get that product back. Now, for you and I, we've got a lot of experience buying things online. It's so easy to do things. You order something, it shows up at your doorstep tomorrow. So the convenience of buying all these products online and being able to return them has just become part of our day-to-day living.
Gaurav, I only got about 30 seconds left here, but what about warranties? And this could help with potential future purchases for people too. What are the questions that you need to be asking?
Warranties, you want to make sure not just the retailer warranty, but also the manufacturer that is making the product does offer extended warranties. If you've got product that may have gone over the return window with the retailer, the actual original manufacturer will probably have extended warranties. So make sure you look at them. You're able to contact the original manufacturer and get a lot of your products fixed if they came up defective. So warranties is really a very important part, especially if you've got those high-end electronic items.
Just a sub-question within that too. As you think about some of those larger electronic items, what are the kind of checks that you should be going through the second you purchase it and get it home to make sure that you don't have a defective product?
Yeah, make sure the product functions as supposed to. Make sure you're also keeping the receipts when you get the product in. Take a few pictures. If you are returning them, make sure you're keeping the original packaging and pay very close attention to the return windows as you get the products back.
All right, that is one thing that I do maybe a little bit too much of, keeping that original packaging here. Gaurav, thanks so much for taking the time. Appreciate it.
Thank you.
Looking for a holiday miracle? Well, the Mega Millions jackpot is soaring to an estimated $1.15 billion. For the winner, that would amount to a cash option of about $516 million, and it's just the 7th time in the game's history that the jackpot has climbed above $1 billion, and the largest prize ever offered in the month of December. Even though no tickets matched all 6 Mega Millions numbers in Tuesday night's drawing, 4 tickets still won $1 million each by matching the first 5 numbers. So, I guess I'll get out there after the show and go get one. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination that comes up at 3 p.m. Eastern Time.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Welcome to Stocks in Translation. I'm Jared Blickery, your host, along with Sydney Freed, the voice of the people. We're going to get started in a second, but first, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Callie Cox. She is the Chief Market Strategist at Ritholtz Wealth Management. It's great to see you again here, Callie. And today we're going to be talking about the outlook for 2025 as we close the books on the first quarter century of this millennium. Our word of the day is productivity. We're squeezing more and more out of each worker these days, what it means for the economy and for stocks. And this episode brought to you by the number 8.5%. That is the biggest drop of the S&P 500 this year. Will investors be buying the dip in 2025? All right, Callie, a lot has happened since the last time we saw you here. What have you been making of the recent market action?
Well, it's been quiet, Jared. You're right. A lot has happened, but not in markets. It seems like the world has almost exploded around them and markets have ignored it. But of course, we had the election. I think the last time I was on was in October. So we had the election. Yes. Markets took the pro-America trade and they ran with it. And now we're quietly meandering along at record highs.
Do you think it's going to be quiet for the rest of the month? Santa Claus rally?
Well, I sure hope so. But no, you're going to hear that phrase a lot this year, Sydney. And I'm glad you brought that up because everybody on Wall Street loves to say, oh, it's the Santa Claus rally when stocks just, quietly move higher in December. And I actually think that phrase is overhyped.
Really?
Why?
Yeah.
Because I only hear it 500 times in December. Yeah, so
only 500.
I agree with you there.
Yeah.
But we're going to circle back to the market action. I want to dive now into our word of the day, which is productivity. Now, productivity measures how efficiently goods, that output, which could be goods or services, is produced, typically calculated as the total output divided by the total input. And that input could be labor hours or resources used. But this is a topic that you're really focusing on in your 2025 outlook. Why?
Right. So productivity is the best economic trend you could hope for, guys. So Jared, you explained it really well, but it's basically the output that we squeeze out per worker. So it's economic output per hours worked. And, productivity is such a loaded term in today's society. How productive am I? Am I scrolling on social media? That's not very productive.
We measure it by how much we use ChatGPT.
Correct. Well, that's part of the story.
All right.
But it really is about the job market. When you talk about productivity, it's the antidote to inflation, and it's the almost the solution to higher growth. The strongest economies we've seen in history have correlated with high productivity.
Late 90s was a recent one. And I think, is that the most recent example? I mean, that was the era of Greenspan, the dot-com bubble, all that good stuff.
I think so.
Productivity.
I think so. That's the one that sticks out in Wall Street's mind. And, if we're being technical, productivity growth right now is the highest since the mid-2000s. But that was really what culminated with the rise of the internet and kind of almost the rebound that we had after the tech bubble.
How do you measure productivity, though? Like, if I'm thinking about my own work, yeah, I'm just like, oh, am I double timing it? Like, how do we measure?
Yeah, that's a great question. And actually, my analyst, Sean Russo, asked me the same thing today. It's a bit of a derivative of money exchanged. But if you think about GDP, it's all that an economy generates. It could be that haircut that you get when you go to the hair salon. It could be that TV that you bought during Black Friday. It's a culmination of a lot of different things. It
could be a subway ride.
It could be a subway ride. But think of it as what is generated by money exchanged.
And so how does the stock market relate to productivity?
Yeah, good question. Because I love talking about economic theory, but we're here to talk about the markets, right? So productivity touches the stock market in a number of different ways. First of all, markets follow the economy and earnings over time. So if there's a strong economic trend happening, in the economy, then you're probably going to see that filter into markets, even if it takes a while, even if there are some disconnects. But productivity, the way that we boost it is by, empowering workers to either learn better skills or giving them the tools they need to do their job better. And both of those are a great story for you and I, the common employee, by the way. But why it relates to the stock market is that it helps companies keep costs low. It helps benefit certain sectors that kind of contribute to these productivity gains. And right now, the productivity surge that we're seeing is really a product of the job market and Americans being historically employed for, about 3 years now. But everybody's talking about AI. Obviously, AI can make you more productive. That could be, the second leg of this product.
Yeah, let's talk about that, because there's been a bit of disappointment about the monetization so far, and I don't know what we were all expecting. Like, is it going to be something like ChatGPT is going to knock down your door and everybody's going to buy a Copilot subscription? It takes time for this stuff to filter in through the economy. And I'm just wondering, what signs are we seeing now? Like, what kind of companies are we looking for to take off, maybe to participate in this AI trade as it finally works its way into the economy?
Yeah, well, this year was all about the picks and shovels. Nvidia, best example of that. Nvidia is not the one rolling out the chat GPTs of the world, but it's the one providing the chips for neural networks and machine learning. So the companies that are tangential to, AI products that we got excited about in 2022 are really the companies that did well this year. A lot of power companies within the utility sector are another good example of that. So when you talk about monetization, though, we're not really seeing it yet. There's a lot of hopes and dreams, but there aren't, tangible profits. Even Nvidia, their sales have been boosted by, the sale of their chips. And apologies, I can't remember the name of their AI chip, but Nvidia's
Blackstorm.
Something like that.
It's embarrassing that I don't.
Blackwell.
I know, I'm having a brain fart, but. Even Nvidia, seen higher sales, seen decent profits, but hasn't really been able to tie the two together. But you have to remember, the story is still early. It's a concept, and that's okay. I think you have to keep that in mind when you're investing in AI-related stocks, but these things take time.
So what do you see in terms of performance of AI and the broader tech sector?
Like, do utilities keep going strong, or how does that factor in?
Yeah, so at Ritholtz, we're telling investors to be really careful going into 2025. And this isn't necessarily an AI story, but it has to do with just the stunning rally that we've seen in tech stocks. Obviously, tech is the most interesting catalyst of the year this year. It's one of the reasons why the S&P is up 20+%. And look, the S&P—
2 years going, too.
Yeah. Tech has led both years. Tech is really the superstar of the market. And that's great, but you have to think about balance, especially if you're a longer-term investor, thinking decades or even years ahead. So we've been telling clients to think about balance, especially if you're worried about how expensive the market is. The market isn't just tech. There are other sectors that are less expensive.
Too.
Expensive, yeah.
Well, let me, I had a really good question there for a second, but let me just expand this. All right, so we're talking about some of the sectors and industries that might be great in 2025. How are you thinking about them right now? How should an investor be preparing to buy that proverbial dip, for instance?
Yeah, well, I think right now you need to take a good hard look at your portfolio, think about balance again. If you see that you have some really good gains in some stocks, maybe think about, taking some of those profits, rotating into more unloved areas of the market. Obviously, we're at the end of the year, so think about tax loss harvesting or keep taxes in mind when you're making transactions. But I think on the whole, just don't be too nervous, but also keep your expectations low. We've seen an incredible 2 years.
But if you have a really long runway,
like Sid.
Like me,
She's young.
This is basically just for me. Don't you think tech is kind of still the way to go long term? Or
we have a number of guests who are saying, don't buy utilities, don't even buy the Dow or the S&P 500, just buy the Nasdaq, buy crypto. You'll be. Not everybody, but that's kind of a theme that younger investors, they need they can just afford that extra juice to kind of swing for the fences early on, or is that not advisable?
Yeah, it's not a bad idea. The problem is not many people can handle the smoke that comes along with crypto and tech. Tech, we'll start with tech. Tech is the superstar of the stock market for a reason, because you take on a lot of risk to get those returns, and it is a sector of hope and dreams in a way.
I like hope and dreams.
Not big tech. Those are some of the strongest companies on the market. But looking outside of big tech, you have a lot of younger stage companies in public and private markets that you have to be really careful about. But they are kind of the sexy attention-grabbing names that everybody talks about. Crypto, same bucket. I think the crypto space is really interesting. I love learning about developments in the space.
And the token names are just great.
I know. I laugh over them every day. But like crypto is also a young, maturing asset class. Even Bitcoin. Just 2 years ago.
Crypto's younger than Sid here.
Is it?
Yes. No, 2008.
Oh, yeah. Yeah.
Okay.
I had to think about it for a second. It's true.
Yeah, well, exactly. And that's not necessarily a bad thing, but you have to understand the ups and downs that can come with that.
What are the sectors you do like then, besides tech or outside of tech? Since we're talking about balancing.
Look, I think tech has some really interesting stories, but when you're looking over the next year, you have to think about valuations and again, balance. And my mind naturally goes to the economy and where interest rates are heading. So I'm thinking rate sensitive sectors, banks, real estate. I think consumer discretionary could be interesting, although half of consumer discretionary is Amazon and Tesla, so you have to be careful. But, economically attached rate-sensitive sectors could be really interesting, especially if the economy holds up.
One of the things you noted to us, and I want to highlight here, is that earnings breadth is pretty good right now. And in fact, in 2025, every S&P 5 sector is expected to increase its earnings, is expected to grow. That hasn't happened since 2018. So what does that mean to you?
It means this rally that we've seen is for real. It's a great sign for
how does that square with your caution? Like, you see all that earnings growth. Could investors be getting ahead of that and saying, well, it's easy to get too far ahead of the curve, but how do you think about that?
Right. Well, what you said, Jared, is exactly how I think about it. Okay. It's a great sign. Look, I'm not going to complain about profits growing, especially when there are a lot of questions about the economy and if there could be the big proverbial R word coming in 2025.
We won't say that here.
Don't say it out loud. He who must not be named.
But earnings growing is a good thing. My worry is that, yes, we've pulled a little bit of this forward and we might be setting the bar too high in 25. And that's not saying that profits are going to fall off a cliff, but earnings expectations are pretty steep. I think earnings are expected to rise by double digits, at least S&P earnings. So you have to think about markets as the information coming in, but also the expectation of that information. And part of this rally that we've seen in the back half of the year has been on the expectation of profits broadening in sectors outside of tech.
Excellent. We're going to pause right here for a second. Coming up, we're going to be talking about buying the dip. Plus, the Fed's dual mandates. They go head-to-head in today's Who Wore It Better? This episode is brought to you by the number 8.5%. That was the biggest drop this year, which is very small historically, for the S&P 500. And that's not even correction territory, which is historically 10%. But two back-to-back years of 20+% returns in the S&P 500, thinking about the potential for corrections next year, what are your concerns?
Y'all, can I just say first, we have been spoiled as investors in the best way. I mean, coming out of 22, did anybody really? I don't think anybody predicted that we'd be up 20+%.
VIX of 13, maybe even 12, yeah.
I know. It's been a great 2 years, even if it hasn't felt too comfortable. And it might have put us in a place where we're expecting too much heading into next year. I mean, 20% gains for 3 straight years hasn't happened in the S&P since the 90s. And before then, I don't think it happened, in the past seven decades.
I was at a CMT event, that's Chartered Market Technicians. So these guys love technical analysis. I wasn't shocked, but I was a little bit surprised how almost universally bullish they were into the end of the decade. And they're not only comparing the present day with the late 1990s, but the 1920s. And people who are market technicians love to go back as far as we have prices. But, there's something ominous there because the 29 crash, Irving Fisher famously talked about it as being this permanently high plateau. It was permanently high for about 2 minutes, and then we got this big crash and everything. So I'm just wondering, how are you advising some of your clients to think about the risks as we head into the new year and just to protect themselves?
Yeah, I think that's the biggest risk, Jared. Our expectations are too high. And that doesn't mean that stocks, could crash next year, but it means that we might be overlooking some of these nascent risks that, could be bubbling up underneath the surface. See, the problem with high expectations, and I love that everybody's happy, it's the holiday season, right? But the problem with high expectations is that you're not as surprised when bad news comes your way. And what I mean by that is, so we have economic data that comes out. We have, the Fed coming out and talking about what they're going to do with interest rates. We have the jobs report. Over the past 2 years, investors have been, clenched up, waiting for the worst case scenario to happen when these economic events have crossed the tape. And they've just been better than expected over and over and over again. We're not in that place anymore. It doesn't feel like we are. Yeah, exactly. We're anesthetized. That is a great analogy for it. And that doesn't mean that the economy may not perform well. It doesn't mean that profits may not grow in 25, but we're expecting that good news. And that means that, we could be let down. We could be getting our hopes up too high.
What are some warning signs then that investors should be looking out for?
I hate calling these warning signs because they're all really good. But, when you see, so there are some sentiment surveys that I watch. There's the AAII sentiment survey. That's individual investors like you and me. There's the NAIM survey of portfolio
We need more letters
managers.
there.
That's
I know.
That's fine.
Finance loves its letters, man. But there are certain surveys that basically ask a bunch of different investors, how do you feel about the market? Where do you see the market going? What are you doing with your own portfolio? And across the board, we've seen a lot of excitement in those surveys, which is great. I love that investors are happy about the gains that we've had this year. But again, it goes back to that, risk, that inherent risk of getting too excited for the future.
How are you thinking about the Trump trade as we come closer to January, where President-elect Trump will be
Everyone
in
got it
office?
wrong 4 years ago, basically.
They did. And that's the interesting thing, because we seem to be going, not we, but markets seem to be implying that the pro-America trade is basically the only game in town right now. And as you mentioned, in 2016, that was the feeling on Wall Street through the end of 2016, and then things flipped in 2017. So first of all, I have trouble talking policy because I don't think anybody knows what could happen over the next few months. So we have a lot of clients ask about tariffs or, tax cuts, what's coming on the horizon. And my answer is, I don't know.
These things, as they evolved back in the day, evolved on a day-to-day basis. Literally, information and big picture information would change on a day-to-day basis. So I support that. Take it as it comes.
Right. But there are things you can do going back to balance. November's gains were incredibly imbalanced when it comes to, U.S. versus international markets. In fact, U.S. stocks had their best month versus international stocks in 26 years. They outperformed by 7 percentage points.
Is EM ever coming back? Any discussions to that effect?
I mean, we love looking at value in emerging markets. You can't, I think
Well,
value
if you're
is at
low
the top
forever,
of the list.
you're very much in the value for a while.
But I think investors are becoming a little short-sighted here. I think that there's a lot of balance to be had. You have to remember that, markets outside the U.S. are very value-focused. They don't have as much tech, but they have a lot of banks. They have a lot of industrials. They have a lot of energy. And, conditions change quickly. What you expect to happen probably isn't going to happen because everybody else is expecting it too. So I think that's what's going on with the Trump trade, back to your question, Sydney. And I think we could see that balance come back into play at the beginning of the year.
Okay. And I want to ask one more on this bull market we're in, because we talked a little bit about buying the dip. We also used the term correction. Is a dip and a correction the same thing? And when would you advise people to buy a so-called dip?
Yeah, this is a hotly debated topic on Wall Street, by the way.
This goes back a long time. I'm thinking of memes that are over 10 years old now.
This was the third rail I just touched.
But I love that you touched it because, I'm in this fight too. So everybody will tell you different things. Jared, you're the technician, so back me up here. But a correction is a 10% drop from 52-week highs.
Basically, that's the way we define it.
Yeah, so 10% drop from a high. That's how, I would define it too. Some people call every sell-off a correction, which I say that's not true, but I understand why you can think that way. So, when we're talking about sell-offs, 5% sell-offs happen a couple times a year. On average, we've seen over the past several decades that's happened. We get a correction once every year or so. The last one that we got was back in October of 23. So what a long-term investor should think about, hearing all of these stats, is that there are going to be ups and downs as you invest. And the drop that you should be worried or kind of on alert for is that big 20% drop. Just because that's where, you see some changes in the economy around, market drops of that size. When you see changes in the job market or, events that people have to digest, around those sizes of drops. 5 to 10% drops are icing on the cake for you if you're...
They're nice. You want them. And then when they happen, you're like, ooh, this is going down 20%. I'm just going to wait. But that's the thinking. We got to hold that thought, because guess what? It is time for Who Wore Better. And today we're going to set the stage with a little imagination, John Lennon style. Imagine there's no price inflation. It's easy if you try. No sticker shock in sight. No prices soaring high. It might sound like paradise, but inflation is only one side of the coin. On the other hand, we have the job market. And when we prioritize inflation or its reduction, we often deprioritize employment. And this is where the competition heats up. The Fed has two mandates: stable prices and maximum employment. The Fed aggressively raised rates a couple years ago to combat inflation. In doing so, it knowingly slowed the economy, which also slowed jobs growth. Now, the Fed is cutting rates currently to prevent a bunch of job losses from turning into a recession. So, Callie, here's the question. Who's wearing the Fed's focus better in 2025? And to be fair, this is another way of asking you which is going to be the bigger thorn on the Fed's side next year. Is it inflation or employment?
Well, I'm not a policy analyst, so I'm going to say unemployment. And the reason why I say that is because, of course, there's the threat of tariffs and, more stimulative policy for the economy that could lead to higher inflation. But right now, if I'm looking at the economy as is in a vacuum, I think the job market is definitely at a bigger risk. And that's what the Fed is going to focus on, which means more rate cuts ahead.
Which is what they're doing right now. But gradually. I call them celebratory rate cuts. All right. So here's another stat from your notes to us that the Fed would have to cut 7 times in 2025 or whatever to get to the neutral rate. And we don't have time to get into exactly that equilibrium rate. But is 7 too many? It just seems like a lot.
It does seem like a lot. And the context you have to add is those are 7 small rate cuts, 25 basis point rate cuts, which is about as small as the Fed will go. But yeah, it doesn't seem like much, right? We already have 2 in our pockets. And, I think traders are expecting 4 more next year and 7 more until we get to that magical rate, according to Fed projections. So, I think before we know it, we could be talking about the end of rate cuts. And if that happens, that means the economy is doing fine, and that's probably what you want. But I understand that people are super price sensitive right now. There's a lot of complaints, a lot of valid complaints about housing affordability.
Sure.
That plays into what happens with rates. And it's a really delicate balance that has a lot of, big camps on both sides. I'll say it that way.
Very well said.
How do you explain like the psychology around rate cuts to clients who are kind of just trying to ask you, like, what do I do with all my money?
What's a basis point?
Well, that's another highly debated topic on Wall Street. Now, when I talk to clients about rate cuts, usually the situation is more around their own money. Rate cuts are coming. I'm reading a lot about the Fed. What does that mean for my own financial situation? And the great thing is that you can pull some threads there. Lower rates on the short end, because of course the Fed is cutting an overnight rate, mean that you're seeing lower savings rates in your bank accounts. You're seeing lower rates on treasury bills, for example. Those short-term obligations or short-term fixed income that you hold in your portfolio isn't paying out as much. But, and usually you see the long end come down with that too, but that provides a lot of opportunity. You can lock in shorter term financing for lower rates. That's great news. You can lock in longer term financing if the long end of the treasury curve cooperates.
We got one more minute. So what's your final word to investors here for 2025?
I'll say it like this. Invest like your legacy depends on it, because it does. And stocks over
That's a lot of
time,
pressure.
Stocks over time have been the best asset historically to build wealth in. So I know we talked about a lot of pros and cons heading into next year. Remember that especially if you're in the earlier part of your journey, you have a lot of assets at your disposal, or you have a lot of tools at your disposal, and you shouldn't be too nervous. That being said, we may not see a year like we have for the past two.
No more 20%.
My legacy is at stake here. All right, we are winding things down here at Stocks in Translation. Be sure to check out our other episodes of the show on Yahoo Finance site and mobile app. We are also on all your favorite podcast platforms, so be sure to leave, comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.